Sam Bankman-Fried, the boy wonder of crypto, built FTX from a dorm room into a multi-billion-dollar empire in just a few years. He charmed investors, regulators, and even politicians with his philanthropy and promises of a brighter future for finance. But beneath the surface, a different story was unfolding. We'll explore the complex web of FTX's affiliated companies, Alameda Research, and the alleged self-dealing that benefited insiders while leaving retail investors exposed. Hi, welcome to Business Insights. Today, we're diving deep into the murky waters of the FTX collapse, a story that's been dominating headlines but still leaves many questions unanswered. We'll uncover the hidden players, the questionable deals, and the red flags that were ignored, leading to the dramatic downfall of one of crypto's biggest stars. Buckle up, because this isn't just about lost billions. It's about a system rigged to favor the few and leave the rest holding the bag. The rise and fall of FTX. Sam Bankman-Fried wasn't just a crypto wonderkind. He was a master illusionist. He spun a narrative of a benevolent genius democratizing finance, all while building an empire fueled by questionable deals and opaque algorithms. Let's rewind to the early days, 2019. A scrappy FTX emerged in the wild west of crypto, luring investors with lightning-fast trades and innovative derivatives. SBF, as he became known, charmed everyone with his hoodie and sneakers look and professed commitment to effective altruism. He donated to politicians, sponsored sports teams, and even bailed out struggling competitors, painting himself as the industry's white knife. But beneath the carefully crafted PR, cracks were starting to show. Whispers of Alameda Research, SBF's secretive trading firm, dominating FTX's order book grew louder. Reports surfaced of FTX issuing billions of its own FTT token to Alameda, potentially manipulating its price. Critiques questioned the exchange's lack of independent audits and unusual margin requirements that favored Alameda's high-frequency trading strategies. Yet, the market roared, fueled by FOMO and SBF's seemingly endless charisma. FTX's valuation ballooned to a staggering $32 billion, and SBF became a crypto king, hobnobbing with billionaires and regulators alike. The red flags. The FTX house of cards wasn't built on a solid foundation. Reports of questionable accounting practices, lack of transparency, and excessive leverage started surfacing long before the crash. We'll examine these red flags like the opaque tokenomics of FTT, the exchange's own token, and the cozy relationship between FTX and Alameda, which raised concerns about potential conflicts of interest. One flag, flapping furiously, was the opaque tapestry of FTT, FTX's own token. Its economics were a labyrinth, shrouded in secrecy and complexity. Critiques questioned its true value, its utility, and whether it was more than just a tool for inflating FTX's image. The lack of transparency surrounding FTT sowed seeds of doubt, casting a long shadow over the exchange's stability. Another flag, flapping in the wind of suspicion, was the enigmatic relationship between FTX and Alameda Research, Bankman-Fried's other venture. The two entities seemed to be intertwined, their dealings veiled in a fog of interwoven transactions and shared ownership. This closeness fueled concerns about potential conflicts of interest, where FTX might prioritize Alameda's gains over the well-being of its own customers. Furthermore, reports of questionable valuations, inflated figures, and potential leverage beyond safe limits painted a picture of a house of cards precariously perched on a shaky foundation. These red flags, ignored by many in the early days of FTX's meteoric rise, served as harbingers of the storm that was to come. But the most chilling flag of all wasn't a whisper, but a deafening roar. It was a near absolute lack of regulatory oversight. While FTX charmed politicians and swayed public opinion, it operated largely in the shadows, unburdened by the scrutiny that should have accompanied such rapid growth and influence. This regulatory vacuum allowed FTX to play by its own rules, a dangerous game that ultimately led to its spectacular downfall. The domino effect. FTX's fall creates ripples across crypto. FTX's explosion wasn't just a flash bulb in the dark. It was a chain reaction that sent tremors through the entire crypto ecosystem. The initial shock wave hit FTX's closest partners like BlockFi and Voyager Digital, who relied heavily on FTX's liquidity and faced immediate withdrawal freezes and insolvency concerns. Smaller exchanges and lending platforms who had used FTX as a key counterparty for trading and margin were suddenly left exposed. With FTX unable to fulfill its obligations, these smaller players faced margin calls they couldn't meet, triggering cascading liquidations and further losses. The contagion spread even further, impacting companies like Genesis, a major crypto lender who had significant debt exposure to FTX and Alameda. Beyond the immediate financial fallout, FTX's collapse eroded trust in the entire crypto market. The image of a seemingly stable and reputable exchange disappearing overnight sent shockwaves through investors, leading to a significant drop in cryptocurrency prices across the board. This had a domino effect on various crypto projects heavily reliant on investor confidence, with many experiencing funding droughts and project delays. The domino effect even reached the real world. FTX's collapse impacted traditional financial institutions with exposure to crypto, raising concerns about systemic risk and the need for stricter regulations. Additionally, the loss of billions of dollars in investor capital had a ripple effect on venture capitalists and startups in the broader tech and innovation space. But the most damaging impact may be on the reputation of the crypto industry as a whole. The FTX implosion reinforced the narrative of crypto as a volatile and unregulated Wild West, potentially discouraging institutional investors and mainstream adoption. While the full extent of the domino effect is still unfolding, one thing is clear: FTX's fall has left a lasting mark on the crypto landscape. The coming months and years will be crucial in determining how the industry responds to this crisis and whether it can emerge stronger and more resilient. Beyond the headlines. Beyond the flashing headlines and jaw-dropping losses, the FTX debacle pulsates with questions that transcend mere financial drama. It throws a harsh spotlight on the very fabric of the crypto world, exposing its vulnerabilities and forcing a reckoning with its core principles. The FTX saga raises uncomfortable questions about power and control. Where do the lines blur between decentralized ideals and centralized manipulation? Was FTX playing a rigged game, with insiders profiting while average Joes were left holding the bag? Did regulators, blinded by promises of financial revolution, turn a blind eye to warning signs while the emperor waltzed naked? This isn't just about billions lost and fortunes wiped out, it's about trust shattered, about the very notion of a democratized financial future tarnished. Can we, in good conscience, build a new financial system on the shaky foundation of unchecked ambition and opaque backroom deals? The FTX fallout compels us to re-examine the core values of the crypto movement. Was it truly about empowering individuals or enriching a select few? Can decentralization flourish in a culture of secrecy and self-dealing? Or does it necessitate transparency and accountability at every level? The answers remain elusive, shrouded in the swirling dust of a fallen empire. But one thing is certain: the FTX saga demands not just our attention, but our active participation in shaping the future of crypto. Instead of a bullet-pointed call to action, let's weave it seamlessly into the concluding narrative. Beyond the headlines, a crucial question lingers. How can we prevent this from happening again? The answer lies in collective action. We, the crypto community, must demand transparency and accountability from exchanges, protocols, and those who wield influence. It's time to break the echo chamber of blind faith and hold each other accountable. What do you think about this topic? Share your thoughts in the comments section below. Don't forget to like, share, and subscribe to Business Insights. I'll see you in the next video.